All right. All right, let's get everybody in here. We will give another minute. Everybody's set up. You guys are all going to be on mute to start with. Connect to audio. You can have your camera on or off for the time being. Good to see you guys. Suna, nice to see you out in California. I got Jen, nice to see you, calling in from Colorado. Awesome to see you. Marilyn, I know you're out traveling too. We've been talking on email. Good to see you. So feel free as we're kind of setting up. I got Tara over here too. I know Tara, you were waiting for this. You're one of the first people on the call tonight, so I was excited for that. Feel free if you want to say hi in the chat. We will get started in another minute. I want to make sure everybody can get on, get hooked up, and get plugged in. So we had almost 200 members of the Lady Landlords crew sign up for tonight's call. So I want to make sure we get everybody in here. But I am really happy that this is a topic that I feel like is going to help so many of you ladies out there. So glad everyone can make it on. All right, we will just give another minute or two. But let me see here. So like I said, feel free to let me know down in the chat box what brought you out tonight, where you're calling in from. Many of you guys know, especially from the Lady Landlords group, that I absolutely despise snow. So I escaped New York. I am living down in Florida for this winter. Many of you remembered I was in the Dominican last winter, but decided I wanted to change it up. So we are currently down in Florida. But I would love to hear where the rest of you are. So feel free to share where you are and what kind of brought you out tonight. So, all right, it looks like we got most of you guys are. Carmen, you're in Florida too. Where are you in Florida? I just actually did a Lady Landlords meetup down here in Florida. I always do the in-person in New York, nearby where I live, but I decided to change it up. I actually did it down here in Florida a couple of weeks ago. Nancy, good to see you. We miss you on the virtual calls. I'm glad you're calling in from Rhode Island. Elizabeth, you're in West Palm. So with somebody else down here in Florida. That's good to hear. All right, Orlando. Carmen, I'm going to be in Orlando and I'm doing a meetup there on March 31st. So I would love to meet you in person. So keep an eye out for some information coming on that. Christina, I know you're in Westchester. I hope you're doing okay with some of that snow you had yesterday. I do not miss it at all. So, all right, we got Durham, North Carolina, we got Florida, we got New Jersey. This is fantastic. I'm glad you guys made it here. Now, as a true New Yorker, many of you guys know that I like to reward people that are on time. So let's get us started here. I am going to share my screen. So give me a head shaking if y'all can see my screen here. Let me know if you guys can see this. All right. So give me 1 second to just make sure we got everybody on mute here as they're kind of coming in. Otherwise, let's get started. Now, as we go along, feel free to please make sure to use the chat box to put any questions in there, and we will be sure to kind of answer them as we move along here. So to get started, I want to make sure that everybody is in the right place and where they are expecting to be. This is the Lady Landlords Deep Dive webinar into syndications. The reason we are doing this tonight is to really talk about how to diversify your passive investment streams. So if we have not yet, my name is Becky Nova. I am the founder of Lady Landlords. As I mentioned, I am a native New Yorker, but my goal in life is actually to be the youngest snowbird in existence. So currently living down in Florida. I'm a cancer researcher by day and a real estate investor by night. I used to live in Spain, where I used to own a tour company, and then I moved into Portugal, where I used to own a bar. Unfortunately, though, I made a really bad decision in the bar that I bought, and I ended up moving back to the States pretty much penniless and homeless back in about 2013. But I was able to find, luckily, real estate investing. And I was able to buy, even in New York, in a competitive market, 10 doors within about 2 years between New York, and then I also own property in the Dominican Republic. And I've been able to create a 6-figure salary by doing so in those 2 years. I then started Lady Landlords to make sure to have a safe place where I was able to ask my own questions about landlording. And now we actually have over 20,000 women as a part of our community that are taking action in real estate investing through one-on-one mentorships, group coaching, courses, workshops just like this. So I am so happy that you're all able to make the time and join us tonight for this presentation. Now, let's start here. Why is this even important? Why are we even investing in real estate? So let's light up that chat box. I want to see what brings you to real estate investing. Are you here for that cash flow? Is that what draws you to real estate investing? Or are you here to make sure that you're growing that equity and appreciation in your properties? You can also throw down in that chat a number 3, telling me that tax benefits is really why you brought you here. Now, I'm probably going to get some combinations and some different answers here. And I'm sure many of you are also going to be able to relate with me with reason number 4 to be here, which is freedom. A lot of us are here really looking for that financial freedom, getting out of that 9 to 5, being able to really live our life in the way that we see passionate and the things that we really do find important in life. I know I'm not the only one here. So once again, give me a 1, 2, 3, 4 here and let me know. So I'm seeing so many people that are giving me 1s, 2s, really sitting here thinking about that cash flow, how to get that extra freedom. And I am so happy to see that I am not alone in that. And you are not alone either. This community is really built to make sure that we think about freedom. But one of our issues is that rentals take time and money. And this is something that we really need to think about within our portfolios. So when we think about reaching that financial freedom, we do have barriers to time freedom. What I mean by that is now we have to work on screening tenants, moving in and moving out procedures, answering maintenance requests, rehabbing units, filling those vacancies, collecting rents up, our accounting, our bookkeeping practices. We have to maintain a property. We have to know our local and federal laws and always be keeping up with those. And we have to deal with all of those sticky situations that makes our Facebook group so active every single day. We all sit there and read those stories of what other lady landlords are going through. And those are all things that really end up kind of taking up our time. On the other hand, we also have barriers to how we can increase our cash flow. I know I'm probably not the only one here that is struggling with really trying to find great deals in this hot market that we've been living in now. I see a lot of lady landlords testing out and trying these new real estate investing strategies where they have to almost start over and relearn a process of what they can do. I see a lot of people that are really considering to buy long distance and move to a different market that might not be so hot, but now you're not getting the cash flow that you really want and you really deserve. So it's really slowing down your ability to reach that financial independence. Also, we got inflation increasing. This is affecting our costs of time, tools, materials, everything that we really need to be able to get done within running our business is just really costing more. And also now we're competing with also increasing interest rates. There are a ton of things that are getting in our way. So this is something that has been really affecting me. And anytime something affects me, I'm sure that there's another lady landlord out there that is wondering the same thing. So over the past few months, I've been spending time figuring out how do we get our time and our money back. So here are a couple options that I came up with. Option 1, we can hire a property manager. But when we hire a property manager, this now is cutting into our cash flow. That's setting us back from really getting to that number, that magic number that we need coming in to really hit financial freedom. Plus, we still actually have to manage the manager. So that's still taking up our time. And now that we have somebody else working on taking care of those repairs for us, we are also now paying a premium to have somebody else take care of our property. And once again, with the cost of labor and materials going up, that's something that does not make me happy and not something that I want to get involved in. I'm trying to make more money, not have more leave my pocket. Option 2, we can increase cash flow by buying more rentals. But once again, this is now time consuming to manage. I know personally, I'm getting to a point where my biggest concern is how much more time do I really want to invest in managing my rentals? There's just a point where that's really going to start to take over things. And then I can't go live my life on a beach like I want to because I'm managing all my properties all the time. Also, we need to actually find those properties. And as we know in this market, that's been a little tough for some of us. I can definitely say that I've been in that situation. And we also need to then make sure that we are financing each of these properties. That means you're either saving for a down payment, you're leveraging different properties, you are looking for different creative financial strategies, which are all out there. But I think we can all agree that there has to be a better way to take our time back and also increase our cash flow. This is where option number 3 came in for me. And this means diversifying your portfolio. So this is where then I came across syndications. And this is something that I've really been working on researching over the past few months. And I'm happy to be able to share this information with you. So here within syndications, we actually can have somebody else managing the oversight of that project for you, overseeing that day to day. That will help us take back our time. That's then going to help us increase our cash flow. And then we have less headaches that we have to deal with. Then we can really just sit back by the pool and collect those checks. So let me see down in the chat, who wants to see how syndications can give you back your time and money? If this is something that you want to learn about, give me a yes or give me a Y down in the chat, and let's make sure to welcome our guests to make sure that we can learn more about syndications. So at this time then, I would like to make sure to introduce John Cohen. He is a partner with Toro Real Estate Partners. Just to give you a little background on how I was able to meet John, I always say, especially in the Lady Landlords Facebook group, that real estate investing is all about networking, and it really starts there. I actually met John years ago after I bought my first property in 2018, and we've actually stayed in touch. So a couple months ago, when I wanted to get really serious about looking into how to diversify my portfolio, I went around and I interviewed a ton of different syndicators. I spoke to so many different people, and I made sure to do all of that legwork that now I want to share with you. As many of you know, when I share a resource in the group, it is where I actually put my money, where I invest with, and the people that I personally work with. So I am really excited to be able to share what I've learned about syndications with you tonight from John Cohen. So at this time, I am going to stop my share, and I'm going to let John bring up his screen and introduce himself as well. So John, are you there?
I am. Can you hear me?
Yes, I can. So John, why don't you share your screen and share a little bit about yourself and start walking us through what you've taught me so well over the past few months about syndications. And I will help moderate, and I will keep an eye out for questions in the chat. So as John's going through, make sure, ladies, you can put your comments down there or questions that you have, and we'll make this as interactive as we can for everybody here, okay?
So can you hear can you see the screen?
Yes.
Awesome.
Oh.
So thank you,
Nope,
Becky.
actually we can't, John.
Okay, let's try this again.
Now I can see it.
That's good?
Yes.
Awesome. So let's see if we can not mess this up. But thank you very much, obviously, for having me. I'm excited to be here. I think you did a phenomenal job breaking down all the fun parts that everyone has to deal with on the real estate side. But let me give you a little bit more background on myself. The plan today is a little bit about us, a little bit about a syndication, types of deals, sample deals, and then please feel free, guys, if you have any questions or there anything specific that you want to dive into, I could jump in and stop or go through anything else in a little bit more detail. So real quick, a little bit about Toro Real Estate Partners. We've acquired over about 4,500 apartments, about $150 million in total equity raised. Now in that number, one of the bigger differences between us and a lot of groups out there, we put our money where our mouth is. So we are and have been about 1/3 to 50% of the equity in deals. So we're not just going to raise money from the public, buying deals, collecting fees, and it's not about the deal. We're only buying deals that we personally believe in. That's equated to about $450 million worth of real estate and about 28 transactions in the multifamily space specifically since 2014. 19 of those assets have gone full cycle. So there is true stats behind these numbers, not just, a new sponsor bought a deal and is now looking to raise money. Our average deal is netted about 28% return. The God's honest truth behind that, we've bought some very heavy lifting deals. We've learned a lot. We've cut our teeth. Those stories that Becky was talking about, I have some that, people probably never want to hear that call, and they've probably already heard those calls. And the market has been phenomenal. So although our returns have been phenomenal, obviously we don't know what the future is going to hold. We formed our company in 2013. We have 233 active investors across all our deals. And a lot of our deals are being sold right now. And we are actively in the marketplace doing the best we can to buy, what we believe to be the best deals out there. Toro Real Estate Partners is two owners. It's myself and my partner, Don Dorenzo. Don Dorenzo worked at Cushman Wakefield. He was there for 30 plus years. His father was actually at Cushman Wakefield for 50 plus years. He was on the office leasing side and investment sales side, all in New York City. So he's extremely intertwined in the real estate world, New York City specifically. He's done everything from ground up construction, office leasing, multifamily, single family construction, whole 9 yards. Myself, my background's in finance. I graduated college, went to school. I should say I played baseball, and school was a background. It was a secondary thing. I got into finance. I worked in finance for 3 years out of college. I absolutely loved my job, but I didn't like the control. I had no control. I was more or less just going on what people were telling me. So I actually left finance and got into real estate. I created my company where I had control. I can pick and choose what we bought. And there was a lot more say in what was going on. And I worked at Marcus & Millichap in Ridgewood and Bushwick, Brooklyn and Queens, doing multifamily investment sales. And that's where I fell in love with multifamily. All of our clients were New York landlords. So while I was there getting listings and selling property, I just started talking to a lot of my clients. And the defining moment for me is when we sold the same building 3 times in a year. And each time we sold it, the owner, the guy we sold it for, was making good money because I saw the entire transaction. At that point, I looked at myself. I said, what am I doing wrong? I'm only as good as my last deal. And if anything ever happens, that's the end of it. And I wanted to be on the other side of the coin. Multifamily was the easy transition because that's what I was very familiar with. Marcus & Millichap probably is the best training platform out there. We got a really good understanding of underwriting, ownership, and everything that goes in behind it. And I spoke to tens of thousands of people looking to buy and owners in New York. And with all of the fun things that New York landlording has to do with your rent stabilization and your rent control, landlord tenant laws, and then the most recent rules about, stabilization and all that good stuff. So I decided quickly to buy properties outside of New York because of landlord tenant laws, the ability to diversify amongst multiple properties or multiple units in one site. And that sort of leads us into the segue of what is a real estate syndication. So how many people out there are familiar of it or heard of it or aware of it? Or, if you guys are, just, throw a yes or a no in the chat. But a syndication is basically, I don't love the word syndication. In our space, it's a little bit of it's got a negative connotation because of what it is. Now, at the end of the day, what it is, it's a bunch of people come together, they pool their money into one LLC or entity and go out and buy a property. In this particular situation, we buy not just multifamily, we also buy RV parks, mobile home parks, land deals, and we have done some ground up construction. So syndication is exactly that. It's myself, a bunch of individuals come together, put your money in a pool, and go out and buy an asset. In this situation, it happens to be real estate. And then in that space, you're going to have 100% of the benefits with none of the day-to-day. So a typical structure behind a real estate deal is going to break down pretty simply. There's the property ownership, and then all the limited partners, which would be all the individual investors. And then there's the managing partner off to the side. So the day-to-day operations fall 100% on the managing member. So in our situation, when we buy a piece of property, regardless of asset class, we're doing the day-to-day. So when the tenant puts a lacrosse ball in the toilet, you don't get any calls. When something really bad happens, there are no calls. Now, we get that information, we do the day-to-day interactions, and that's all reported to investors on a quarterly, monthly, semi-annually, whatever the deal calls for. Typically on our deal specifically, we're doing no less than quarterly reporting. And then depending on how heavy lift it is, if we're doing a very heavy lift deal, which might take a lot of capital, we're giving more updates so the individuals know what is going on. But that's how you're typically structured in a real estate syndication. So there's nothing special fancy about it. It's just a regular LLC, and you are protected by the LLC, whether you invest as an individual or if you invest as an LLC, or if a couple people come together and invest. The LLC is the protection for you. And then the structure is a limited partner and a general partner, or a managing member and a passive investor. So that's how they typically break down.
Oh, John, can you go back for a second? All right. One of the questions that I would love to ask on that for the typical structure screen that you brought up, when once again, I was talking to different syndicators, learning about this process, I kept getting a ton of acronyms thrown at me, right? I got that GP, that LP. Can you make sure just that we really understand where that GP is and what their role is, and then really then who fills out that LP kind of partner, so we make sure that we understand what your role would be versus what our role is?
Absolutely. And I do have like a little one page, like cheat sheet, you could call it, that if anyone's interested, reach out to Becky and I'll send that to you. But yeah, so there's a lot of things that, a sponsor, a syndicator, a general partner will throw out there and either assume or not really break it down. A limited partner or an LP or a passive investor, all three being the same thing. Those are the individuals, very hands-off, almost no worries. You sit back and you let the general partner, sponsor, managing member do the day-to-day operations. So that's the parting line. It's basically limited partners, passive investors, LPs are investors. The general partner, managing member, and or sponsor is the one doing the day-to-day, in the weeds, touring the property, whole 9 yards. Now, within that structure, obviously the general partner is compensated for the day-to-day work. So it's not unsimilar to, let's say, hiring a property manager. The biggest difference between what we do and just a regular 2, 4, 6, 12 unit property is that the management companies that we use are probably significantly larger. And if you want the easiest example that I can use is a single family house. If your average rent on a single family house is, let's call it $3,000 in New York, maybe plus or minus $1,500 to $5,000. If they're collecting 10%, they're collecting $300. $300 times 12 is $3,600 a year. There's not much profit in that $3,600. So that single family or smaller management company needs a ton of clients to really have, make a good living. Not unsimilar to a regular investor that realizes one single family house generates X cash flow and all the work that goes into it. And they have to either buy more, manage more, leverage more to generate more returns. The difference here is that, the property managers are not normally charging 8 to 15%, and it's normally somewhere in the 2 to 5 because the properties are significantly larger and it's all under one control. Now, not one roof like a building in New York City. It might be garden style, which is spaced out, but it supports management. You have a full-time manager, a full-time operator. They do the day-to-day. They report back to us quarterly, weekly. We have pretty rigorous requirements that we report so we can understand what's going on. That's the general partner. We take that responsible. We pass that information on to our limited partners and investors, and they sit back, they get the reports, and they could be as active reading them as not. And that's that structure. Is that a better cheat sheet? And I will pass along the actual lingo so everyone has a copy of it.
Yep. I'll send that to me, John. I'll make sure to send that out with the recording to everybody that's on the call tonight. So also with that limited partner, last thing I'll ask about this. So the limited partner could be me as an individual or me as my LLC investing into this structure, correct?
Absolutely. It could be an individual, it could be an entity, it could be an IRA, it could be a trust, it could be a pension plan, anything you want it to be. So there's no restrictions on who invests. That's personal choice. In all of our deals, we invest alongside of our investors. So in a structure like this, I may come in as the managing partner because I'm the one doing the day-to-day operations, but John Cohen as an individual or my entity would come in as an LP as well. So if I put raising, let's say 500,000, I put in 250 and Becky puts in 250. We both go in as limited partners, but the managing member of that entity would be, in this case, how we normally do it. It's Toro Real Estate Partners managing member 25, right? Whatever number we're up to, which is that day-to-day operations. And there's a reason for that, which I'll get into a little bit later. But yes, so you can invest in any way, shape, form, joint tenants, however you see fit, whatever best fits your situation.
Perfect. And I love that you put your own skin into the game too.
Yeah, that's one of the things that we will get to a little later. But when you're vetting a sponsor, and to take it from me, I'm not the only one out there that does that. We are a dime a dozen. But one of the first things that I always like to know, and I invest passively in other people's deals because sometimes I don't want to deal with the headaches of our own deals. That's the first question we always ask is, what are you putting in the deal? Do you invest in the deal? And there's some other things that you want to ask in that, and we can get into that, in one of the later slides, or if anyone wants to get into some questions like that at the end.
Sure, thank you. I appreciate you defining those terms for everyone. Thank you.
Not a problem. And I was just trying to look. I know I have it somewhere. There's also a really good book that a friend of mine wrote that basically any limited partner should read. It's written by Brian Burke. He's a very, very, he's been doing this for 100 years. And he's got basically an entire book about, a limited partner. Like as a limited partner, these are all the questions you want. There are things in there that he would self-admit are really redundant questions and no need to ask, but I will get you a link to that book if anyone wants to read about being a passive investor. It's a really good starting point because it's going to give you basically a tool, a whole tool belt of ammunition to go ask sponsors and vet sponsors.
Perfect. I'll add that to the follow-up email to everybody.
Mm-hmm. So I think the biggest thing to understand investing in a syndication is the pros and cons. The pros are, in my opinion, far outweigh the cons. Let's start with the cons because that's the stuff that people have questions about in reservation. The biggest thing that's against syndication is control. Obviously, most people here are landlords. So you guys know what it's like to do the day-to-day. That's good and it's bad because you know what it's like to do the day-to-day. So you understand the things that go into being a landlord and dealing with tenants, the rules, regulations, and where you're at and everything that Becky had defined earlier on. But the biggest con on this is obviously control. As a smaller investor or as one of the group of investors, when you have no control, you can't call up and say, hey, I want to sell this asset. It doesn't work that way. You're sort of in for the ride for whatever that deal's plan is to be, whether it's a 5-year deal, a 10-year deal, a 7-year deal. Understanding that is probably the biggest negative against syndications because you can't change your mind. I want to go get debt. I want to take my money out. So as far as your control, obviously everybody here, if they're a landlord, has that type A personality to a degree, right? You want to be in control. That's the biggest negative. The second con is that along with that, it's not liquid. So we tell everybody that invests in our deals, if we do a pretty good vetting process up front, we want to understand who our investors are and what their abilities are, because we don't want someone to take the last 50,000 or 500,000 or 5 million out of their account and invest it, and then 3 weeks later call us up and say, I need my money back. The biggest thing for us is that not only do all investors understand the deal, which is another thing that any limited partner wants to know, you want to understand the business plan and what that playbook is going to look like, because you can't just go onto your Fidelity account or Charles Schwab account and just sell the stock and I'm out. Now, in our deals, because we are well capitalized and because we invest in our own deals, we will do everything in our power to get you out of a deal. In the worst case scenario, out of the 28 deals we've had, we probably had 4 or 5 investors that have called us 3, 4, 6 months into it and said, hey, is there anything I can do? And we will do everything in our power to do it, in our operating agreement, which we will get into the documents a little bit later. In our operating agreement, it will say in there the rules of the business, basically how it's defined. And one of those things is obviously if someone wants out, their shares or their investment is offered up to everybody in the group to see if anyone in the group wants to buy that person out for cost, for a little bit of a loss, maybe for a gain, just depending on how the deal's performing. And then if nobody raises their hand, obviously we are more than willing to accommodate. But that is a big negative. It's not liquid. You got to go into it understanding that, your money is tied up for quite some time. One of the other cons is obviously there's profit sharing. So whether it's a con, whether it's a benefit, as a passive investor, the general partner, the managing member gets compensated for their time, energy, effort, finding the deal, just like in any other real estate transaction. If we bring a deal to the table, we're raising money, we're putting our money in, yes, we do charge an acquisition fee, and we will get into, fees and other things that people charge, but there is typically a fee up front, there's typically a management fee, but on the same token, this 8% preferred, or in this specific instant, all money that comes out of the deal goes to investors first before the manager gets paid. So although it is a con, there is some pride of ownership, because if we don't perform well, we're not going to get paid. So, and then after those splits, there's typically profit sharing. So I look at that as a con, obviously, because 100% of the deal does not go to you, but based on the performance of the deal, the better the deal performs, the better the individual does, the better the sponsor does.
That's also a little bit of the cost of doing business within something like this.
Correct.
Right?
It's at the end of the day, the easy analogy is when you go to a store and you buy something, and we could use the grocery store, and you buy an apple and it's $2, or in today's world it's $6. You can't go to the clerk and say, I'm only going to give you $1. It doesn't, right? It's the cost of doing business. It's part of the game. Any sponsor out there, these structures, I just put in there that 8% preferred, 70-30, they vary deal by deal, space by space. So it's, this isn't gospel or by any stretch of the imagination, but it's the cost of doing business. Hey, we're offering you a really good product, a really good deal. This is what it's going to cost you to, cost to play. So just like anything else, you pay for what you get, sort of. But that's one thing that people look at, and everyone's counting everybody's money, and I completely understand that, as does everybody else. But at the end of the day, that's the nature of the beast. Now the pros. The pros, I think, far outweigh it. I wanted to make it look more equal and not skew anyone in one direction or not. So I did list 3 that I think are more important than others. A passive investor in real estate, you don't have any responsibilities. So all the things that Becky mentioned, that long list of day-to-day responsibilities and those war stories and all of that stuff, you can basically take that off the table. When you invest in a syndication, we will do all of that, all the day-to-day, all the banging your head against the ground. It doesn't mean you're not going to know about it. So yes, in this particular situation, you might have to not deal with the day-to-day, but on the investor report, you might see bad things, but you don't have to worry, that might worry you as a day-to-day, but you're not going to have to deal with it. So that's one of the biggest pros. You're very hands-off. You can sit back, you can collect your cash flow, you can do the things you enjoy and not have to think about what's going on after you get over the control and after you write your check. That's probably the biggest concern. Another pro, the longer your money's in a deal, obviously, the more returns it should generate. So you can put your money somewhere where it's going to generate a return for a projected period of time. So if you have $100,000 and sit out and going out and buying a single family house and letting it run its course and then having to refinance it in 6 or 12 months, in this, you could say, okay, I'm going to put a chunk of money to work and then more or less, hands off onto what you like to do, whether it's your day job, whether it's your day, your 9 to 5, or the things you love, when you have enough money again and you want to invest again, hopefully there's another deal, another sponsor, another opportunity. So you don't have to think about your investment on what you're going to do, how you're going to place it and stuff like that. And then passive investor, you're going to get all the benefits of real estate, all your tax benefits. You're going to get the benefits passed through to the individuals 100%. So you really have nothing to worry about. Cash your checks, get your upside. You still get all the benefits with none of the downside. There's no liability. You don't have to sign on a loan. Caveat that you don't put in a certain amount of money, because if you put in more than 10 or 20% of the total equity, sometimes banks just want to understand who the investors are. But for the most part, you sit back, collect your check, and you can relax. So a typical timeline, and this is a good way that I like to show things to people. A single family investor, let's say someone's brand new off the street and they've never done real estate. They go out, they want to buy a single family house, and they say, okay, I'm going to buy a house over the next 6 to 12 months. And they purchase one house with $200,000 in your bank, you buy one house. More often than not, you have to reaccumulate money to buy your next property. Now, after you buy one single family house, you get more experience. And then you say, okay, you know what? I'm ready for a duplex. Now you either can sell your single family, or you can then go find a duplex and buy a duplex. And now you have 3 units. Then same thing. You go back to your day-to-day. Maybe your property's performed really well. You could refinance. And now you say, okay, I'm really experienced. I'm going to go buy a 4 unit. And now you have 9 units. And then your 4th deal, whether it's a year and a half or 4 years later, just depending on how fast you move, you buy an 8 unit using the similar strategy. Now over, a year and a half to 4 years, you've acquired 12, 14, 15 units. Those 15 units are going to produce a certain amount of cash flow. Now there's appreciation, upside, whole 9 yards. That's as an individual investor. And then with each of these comes more responsibility, more headache, more tenants. One tenant stops paying in a duplex, now you're 50% occupied. If you have debt service, maybe your single family is now just paying your debt service and your cash flow's gone. Same thing on a four unit. One person moves out, you're 75% occupied. Now maybe your duplex is paying your debt service. So with each of these comes more responsibility, more headache, more loans, more debt, unless you're paying them off as you go, versus a syndication. Syndication, let's say you take that same $200,000 that you bought your first house with, whether you bought it all cash with no debt and or with debt, and you said, I'm going to take 6 months to understand it, get a better familiarity with it, and then I'm going to talk to multiple sponsors and interview 5, 10, 20, 30 sponsors, try and find maybe, I really like the Southeast. I want to move to Florida, so I want to invest in Florida. Let me find people that are buying properties in Florida. You can put the same amount of money into your first deal, and now you have diversification over 200 units in one area. So if 10 tenants leave, you're 95% occupied. Whereas if 10 tenants leave in the first example, you're very, very, very vacant. So one of the benefits is obviously diversifying your risk, spreading your risk, where you don't have to worry about, how am I going to make my debt service payment? How am I going to, it's not cash flowing. I have another eviction. Here, you get that risk spread out across everything. And then at the same time frame, maybe it takes you a little bit longer because you put in a little bit more than you would have for a single family house. As you can see, you can go up, and then over the first 3 to 5 years, you could be an investor in over 1,500 units, where you're going to have a lot of diversification, not just in one property, but maybe it's the same sponsor over multiple properties. Maybe your diversification is, I'm going to invest in 4 deals with 4 sponsors and see how each of them do it. Maybe I'm going to take, just like the example above, instead of buying 4 individual properties, I'm going to buy a value add deal. I'm going to buy a very stable deal. I'm going to buy an A-class deal. And then I'm going to go, buy, something in between. Or same thing, let's say you really enjoy to go to the West Coast to ski, or you really like Colorado and you say, I want to buy a duplex in Colorado. Great. But if you live not in Colorado, it's going to cost a lot of money, time, energy, and effort to manage something remotely. In a syndication, that pain is sort of taken out. You could live on the beach in Florida, in the mountains in Colorado, and you can invest in Houston, Texas, or Dallas, Texas, with a sponsor that is familiar with there. So if you're online and people ask all the time, how do I start investing in real estate? I say, go on Google, type in the top 10 locations in the world for real estate. You'll see the same locations that pop up on every list. And then you dive in and you try and buy property there. And you realize that, oh, these markets are competitive. There's a lot of competition, but I really want to be in Florida. Well, this is an alternative way to find something in your area. And as this grows, your 200, 400, 650, 1500, or whatever that looks like, your headache goes in the opposite direction. Because if you're still investing in syndications 3 to 5 years down the road, and you've invested in multiple, there's obviously a lot more trust with either a sponsor, multiple sponsors. And now by this time, your deals might be coming full circle. So if you bought that first deal and now it's 5 years later, that deal might be ready for sale. That 200,000 and now has appreciated. It has grown. You have cash flowed. And where the top line, you may get more headaches as time goes on, as you acquire more units because you're doing more of the day-to-day. It's the complete opposite on the other side of the coin, where you're actually probably going to have less headaches, more cash flow. The more you acquire, there's more going to the bottom line. So that's a pretty good barometer of where a lot of people are. Maybe they have 9 apartments right now, 10 apartments right now, and now they're sick and tired of the day-to-day. And it's taken them 4 or 5 years, where now it's time to maybe, okay, I've done the single, I've done the duplex, or I started with an 8-unit, whatever it looks like. I don't want to buy another 8-unit because I have to do the day-to-day. It's on the other side of the coin. It's okay, I'm gonna own my 8-unit because I love it. And now I'm gonna put my next investment into a 200, 400, whatever type property that looks like. Any questions?
I think we're doing good on questions. I'm monitoring the chat down there.
Got it. If there's anything specific,
I'll make sure to read them out. Otherwise, we'll make sure that we'll save the last 10 minutes or so before 8 p.m. We'll make sure to save for any general questions we have.
Awesome.
Yes.
All right. So types of deals. So we are not just multifamily operators. There are sponsors in every single asset class, whether it's self-storage, whether it's multifamily, whether it's office, whole 9 yards. What we specialize in, obviously, multifamily has been our bread and butter, mobile home parks and RVs as well. Vacant land has been something that we played around with early. That's how I actually first started buying real estate, and now it's back on the cards. And then, basically that asset management ground up, that day-to-day. So these are the things that we do that our investors don't have to do, is basically take advantage of multiple asset classes, multiple locations, and we handle your day-to-day operations. And each one of these deals are going to be a little different the way they're structured. So keep that in mind. But these are things that we offer. We're very good at. We have really good relationships with other people if people want to see more deals. But these are things that you can absolutely take advantage of as a passive investor, taking advantage of a little bit of, a lot of different asset classes and not just one-off landlording on single family duplexes, 10 units, whatever that looks like. So I will go into just one specific investment strategy that we have right now. Obviously, there's a massive demand for housing, and we started buying vacant land about 2.5 years ago and targeting in areas with high demand. And right now, mostly focused in the Texas area because of the demand. And the principle here is supply and demand. So if there's no supply in the market, and as landlords, as people looking for deals, everybody here knows that there's very little inventory on the market. Multifamily, single family, commercial space, whole 9 yards. So what we've been doing is actually been buying larger tracts of land, subdividing it down in markets with no supply. So if there's, for math, 100 properties on the market and they're all pending or contracts, or they sell within 2 or 3 or 5 days, 30 days, whatever it is, we're looking for larger tracts where we can subdivide down to a very usable property and then add supply to an area with a lot of demand, with a lot of multiple exit strategies, where one of the strategies, we'll sell it to a developer, we will sell it to individuals, we will sell it for recreational use, whole 9 yards. So that's one strategy we have right now that has been performing really, really well over the last 2+ years, and something that we are actively scaling and definitely looking to build. The plan behind it is really simple. This is basically a graph of the MLS in one county in Texas that's just north of Austin. As you can see, as you buy larger tracts of land, your per acre price drops significantly. So one thing that we're targeting, and the y-axis acre, the acres down here, and the is that, so you could see that if you buy a 4-acre property, the price per acre is significantly higher than a 40-acre property. But if we could buy a 40-acre property for, let's call it 10,000 an acre, and subdivide it down to 4 acres, 10 4-acre properties, we're going to get a significant premium. So that's basically the land strategy for us. And here's a better graphic of that. A 10-acre property we buy for 200,000, we subdivide it down to 5 2-acre lots, we sell for 44. You could almost buy a property at market price and still generate twice your money by subdividing it down minus cost. Now, these are things that most people aren't looking at. Most people are just buying a single family house for cash flow. So this is something that we've explored, we've done really well in, and they're also, we're scaling this significantly.
And I actually found this really appealing. I know usually when we think of your traditional syndications, we think those apartment complexes, right? But to me, that then also brought up the same issues that I feel like we all as landlords have on a daily basis. This problem with this tenant, this vacancy. I got to say, there was something like really just peaceful about the idea of no worries about an eviction moratorium, no worries about, vacancies, no worries about all those different ideas. Just really that idea of nice land that we can buy that could be then used and subdivided. I thought that was just such a unique opportunity that I was just really outside of what I had always expected with just the very typical multifamily syndication. So I think it's really cool that there are options within syndications for really how you can even get involved there.
Yeah, 100%. Syndication, like you said, it's not my favorite word, but it's what's out there. Most people think syndication, multifamily deal, or commercial deal. We realize that in COVID, if anyone owns property in New York or throughout the country, when everything stopped, I think when it first happened, everyone on this call probably had a heart attack and said, who's going to pay their rent? What's going to go on? No one's going to have jobs. Unemployment went through the roof. And I think it gave everybody what's going on? And we realized that, you tried to help your tenants the best you could, and you did the best you could. But at the end of the day, there's still debt and you still take care of it. This strategy for us was a way to diversify where we don't have to deal with tenants, and we're in areas where there's a lot less headaches. So on these types of deals, the other big thing here is that in the marketplace today, how many people are looking at deals daily, and all these deals are listed, and whether you have to send out direct mail or you have to find something off market, maybe you have the time, maybe you don't. In this strategy, you can almost look directly on the MLS and or any type of listing website, and you can really almost buy deals at market price, especially if you go direct to owner. And at market price, by doing a little work and dealing with the county, not necessarily an individual like a tenant that needs to get a job or pay their rent. Here, you've got a vacant land, you have good insurance, you have a liability policy. You, like Becky said, you could go out and you have stress-free. And then in a syndication, you're not just going to buy one deal, you're going to diversify that risk over 4 or 5 or 6 different opportunities. So it was something that we started doing. We started doing this, when I was in finance, I actually was buying land, and then we moved on to the multifamily and all those other things. And then in COVID, when I was sitting in my, my office in my house, realizing like, how am I going to get on a plane and travel to go see property? What am I going to do? We started buying it again, and we started with all our own cash. And then we just said recently, okay, this is very, very viable. Let's roll this out to investors. And, it's been relatively successful so far. We're really excited about it. Keep in mind that our bread and butter multifamily, we are doing those deals as well, but we want to give our investors basically, almost a, buffet of different types of deals that we know we can execute on. This is how we're doing it. We are sending out a lot of direct mail. We are sending out a lot of texts. We are calling a lot of people. Whether you buy a deal on market or not, we're sending out about 50,000 mailers a week. 50,000 mailers a month and 10,000 texts a month. And we are buying direct off-market opportunities. And our vetting process for these land deals specifically, We identify our markets. They're all in these high growth areas, mostly throughout the Southeast, Midwest, Texas, the areas that are on everybody's radar of where they want to invest. We download all our ownership records, and then that's when we send out, 50,000 offers, 10,000 texts, and we are upfront in the face of our potential buyers or potential sellers. We underwrite any accepted deal. We're getting about a 1% acceptance rate on about 100,000 offers. So we're super selective. So the biggest funnel is I want to buy stuff in Dallas. Then it's, okay, what do we want? We want to make sure it's 200 acres plus. We want to make sure it has good road. That funnels down. And then we're basically being extremely selective on what we buy. And then after we get an accepted offer, it's another vetting process, all of those due diligence questions that everybody does when you get an accepted offer. On a house, you got to check the plumbing and the foundation and the roof. And when your roof goes in a single family house, kiss your cash flow goodbye for the year. Here, the due diligence is significantly easier. There's more of it. You want to make sure there's access. You want to make sure the soil is okay and all of that good stuff. But when you finally get down to an accepted offer, it is very, very, very well vetted. And it's passed a lot of tests. So it gets it very, very narrowed down into deals that we have a lot of confidence in delivering the final result. So, and this is not different than our multifamily side or our RV side either, and mobile homes as well. We are not just waiting for deals to come to us. We are in the trenches day to day. We are fighting that battle. So when we do present a deal to our investors or our potential investors and we send this out there, they know that, we've gone 10 rounds with, Mike Tyson. We're in the trenches, we're fighting. We are putting the best deal forward that we believe in, because we're not trying to just buy a deal to generate a fee or buy a deal to place money. We are actively investing with our partners. And, yes, GPLP, as Becky said before, we don't look at deals that way. We look at deals as, this is a partnership. We might be running it, but we are all going in this together. And this little funnel is not very different from a multifamily deal or something like that. We are underwriting thousands of deals to buy one deal. Since 2014, we bought 28 deals. So, 9 years, 3 deals a year, plus or minus. So we are very laser focused on what we buy, because we know and we audit every single quarter, every single year. Okay, what did we really do well this year? What did we not? How can we do what we didn't do well better? And how can we do what we did well replicated? So when we buy a deal going forward and everything, we are actively in the market dealing with those day-to-day, so our partners don't have to. That's probably the biggest thing that I think this funnel outlines, is that we're doing the work for our partners and potential partners, so they can go off and do what they like to do.
And for that acceptance rate, just out of curiosity, is that like a normal acceptance rate? I understand that's your acceptance rate, but do you feel that other syndicators kind of maybe don't have that same underwriting process, and maybe then don't do as much like due diligence, but then maybe they take on kind of too many things that aren't necessarily right for them? Like, can you talk a little bit about like what your acceptance rate is compared to another syndicator?
Yeah, no, for sure. I think everyone's going to be a little different, and I don't want to just pound on other people and say, we're the best. But no, I think we're very selective because we are contributing a large chunk of our own money to deals. So there are a lot of syndicators out there, and that is, if anyone takes anything away from this, forget the slides, what I've said. You want to make sure that your syndicators are pot committed to the deal, because what I've seen a lot in the syndication world on the multifamily side and all these product classes is that at the end of the day, I'm going to know if something's wrong before any of my investors. And that's not, I know something's wrong, I'm not going to tell you. But I get the call first, I get the email first. If I don't have my money or my time committed to that project, and I have another project in the pipeline, well, I'm going to wave the white flag. And if you're an investor in that deal and I find a better opportunity where I'm going to potentially make more money, that's where the relationship breaks. Our acceptance rates is that low. We've looked back and there was countless deals we could have bought that in today's market have been way more successful than we ever thought, but we passed on them because it's not where I wanted my money to go. So I don't know if this acceptance rate for other people is high or low. I would assume mine is probably on the lower end of most, just because we were very, very, very selective. But if it was higher, it doesn't mean it's a bad thing. as long as their staff and their team and their management can handle their inflow. It's a hot topic in the real estate market for the last 5 years. There's a lot more people doing it now. We see it now too, even on our offers. When we're offering on deals, we're losing deals by 10, 15%, 20%. And the top groups are groups that just started 2 or 3 years ago. The deals we're selling, if I look at, we just signed a contract today on a 360 unit deal that we're selling in Ohio. The top 10 offers were groups that haven't been around for 3 years. And on the lower end of that offer, it was groups that've been around 5, 10, 15 years. So it's like, do the new groups know something that the old groups don't? Or do the old groups know something that the new groups don't? So one way or the other, and I'm not here to be partial, I think our acceptance rate is on the lower end for the simple fact that we are 100% committed to the execution of our own deals, not just executing on, let me raise 20 million for this, 20 million for that, get a lot of fees, and sail into the sunset because I've collected a lot of money. So I think the acceptance rate is an important thing to understand, but making sure that they have the ability to execute is the most important thing.
Absolutely. Thank you for explaining that.
No problem.
And just a reminder, I'm answering questions and I'm taking notes on the questions that we're going to make sure that John answers at the end. So feel free to keep putting them in the chat. We'll make sure everybody gets their questions answered before the end of the call. Okay.
Awesome. And I'm going to wrap up this basically sample deal. This is just the land deals. These are 5 deals that we are actively, we own 3 of them. We own this 10-acre property in Montgomery. We own 17 acres. We own the 700 acres in California. We are buying this 160-acre property at the end of the month, and we are buying this 100-acre property. It's actually not March 12th. It was pushed to the end of next week. So these are active deals that we are doing. I can give you some insider information. This Montgomery property deal we bought for 10. It's that perfect example. We have all 4 lots sold now. And then on this El Dorado property, we just accepted an offer last night at 10 o'clock for full ask with a 40-day close. So these deals are actually bought and sold. They are all lumped together in one syndication deal. So any investor gets a little piece of all of these, but these are active deals. I can gladly go into more information, or I think, I saw a ton of questions coming in, but that's, this is on the land side. We also have a mobile home park coming out. Probably, hopefully, let's assume at the beginning of Q2, and we will have a multifamily deal. I'm very confident coming out in the Q2, let's say end of May, early June, because we are, we are underwriting a lot of those deals.
All right. So let's make sure that at this point, so I'll make sure too that everybody will get some, I have everybody's questions written down, so we can definitely make sure to kind of go through those there. The other thing that I want to do, John, I'm going to take over control of sharing my screen. Once again, this will be sent out, so you'll also have John's information there. But just since we are getting close to 8 o'clock here, in case anybody has to go, what I do want to make sure of is if you are interested in discussing your personal situation with John and myself, we are absolutely willing to have that conversation. Make sure to go to lady-landlords.com/syndication, and you can fill out a form there, and I will reach out personally to you to make sure that we can set up a call. I'm also going to be putting that link down in the chat box now, so you can go directly to that and make sure to book a time with John and I to kind of talk about your specific situation and if this might be something that would be a good idea for you or not. So also, in case anybody has a hard stop now at 8 p.m. over on Eastern Standard Time, make sure if you have any questions that you still want to reach out to, you can always find me, as always, in the Lady Landlords Facebook group, or you can also send me a message on Instagram at BeckyNova24. But we have a ton of questions here. So what I'm going to do is I'm going to share my screen. So I'm going to stop sharing my screen so we can see everybody here. And then let's go back through some of those questions. So one thing, John, that kind of came up a couple times here is when looking for a syndicator to work with? What are some questions that maybe a new investor should be asking to know if it's if it's legit, if this is a good person that knows what they're doing, or maybe somebody that's not a good fit? And what are some of those red flags that we can then look out for and then say, okay, this is really not a person that we should be working with?
So level of comfort is going to vary individual to individual. I think the biggest question that I like to ask is, do you have money in the deal? If so, how much? And it's a loaded question because a lot of these deals charge acquisition fees. So it's typically anywhere between 1% and 5% of the purchase price, just depending on how large the deal is. Our typical fee is probably anywhere between like 1% and 2% because our normal deal is anywhere between like $15 and $30 million. But make sure you're asking how much money is in the deal net of the acquisition fee. Because if you buy a $10 million deal with a 2% fee, that's 200 grand. If the sponsor is only putting in 200 grand, it basically means they're either going to get paid and put the money in, or they're putting 200 in, but they're getting 200 out the same day. So there's almost nothing in there. So one thing I like to ask is obviously making sure how much money they're putting in net of all fees. So they're actually putting capital in, not just going in a circle. The other big thing is it's tough to verify this. You can ask for it. We'll provide it. We'll provide balance sheet financials for ourselves. But you want to make sure your sponsor is relatively financially savvy. You don't want to buy a $25 million deal with a sponsor that doesn't have the net worth or anything like that. Now, banks are going to require that stuff. But if something goes wrong, it's the sponsor on the chopping block. Investors have no risk to the loan. They don't acquire the debt. More often than not, it's non-recourse debt. But just make sure, if something goes wrong and you're raising, let's say we raise $5 million for a $15 million deal, if we run out of money or if you have to do a capital call, if all the investors say, no, I don't want to put any more money in, well, where's the money going to come from? So make sure your sponsor has the ability to have cash available, because if not, the deal's going to suffer. It doesn't mean the deal's going to be bad. It doesn't mean anything like that. But you just want to make sure that the individual running the deal is well capitalized and or the deal is well capitalized. So if the individual might not have a ton of liquidity, it's not bad. But if the business plan is to raise 5 million and 5 million cuts it right to the bone, we like to raise a little bit more. You'll see it in our documents. We have the ability to raise 10% more or less because through the process, things come up. So we want to just make sure we're well capitalized. In a lot of our deals, we raise more than we're supposed to. After 6 months, 8 months of ownership, we typically do a little distribution if we're overfunded, because that's when you really have full understanding of what's going on, the day-to-day operation, stuff like that. Those are the two things that I think are most important, is their level of commitment. Along that level of commitment, how many deals they currently have going on. You want to make sure that they have the resources to manage all the deals that they're currently working on.
Perfect. Thank you. And actually, you hit on two other questions that we have in our group, just as you were giving that answer. So one question I got down in the chat is, John, what happens if the syndicator does not do a good job? This whole deal blows up. What happens to my money?
Yeah, that's a fantastic question. So there are three things. The first thing is, obviously, here's the caveat. The lawyer would pat me on the back. It's a real estate deal. Everybody knows you can lose 100%. But it's unlikely if the sponsor understands what they're doing, they've underwritten the deal right, and they have the right debt. Stepping back, definitely understand the debt that the sponsor's putting on the deal, so you understand what that looks like. But if the sponsor does a horrible job in the operating agreement, so there are typically 3 documents that you'll have to sign. One's going to be an investor questionnaire, which will detail out everything about you as an individual, what you're putting in, are you an accredited investor, how are you investing, so on and so forth. The next agreement is a subscription agreement, which is basically your subscription to the LLC. It'll show how much money you're putting in. This is my commitment to the deal. And the third is the operating agreement, or the first is the operating agreement. The last is the investor questionnaire. The operating agreement is the governing document, just like any other operating agreement for any business. It will clearly define the business. So for instance, in our deals, if we do a poor job, you will see it in there. Becky, you can audit this. If we do a horrible job, all of our limited partners can come together and vote us out as manager. Now, if I have money in the deal, I will still be a limited partner, but I will no longer be in control. Now, then the next question is, who's in control? It would be a collaboration of all of the LPs. So everybody would have a little bit of say, or you guys can vote in someone else to run the deal. That's more or less worst case scenario if the sponsor is completely crazy. There's obviously things in there. If he steals money or does things completely wrong, you have criminal liability. You can go and get, you could go after him and the deal. The good thing about syndications and buying into one of these deals is that you are an owner of the property. So you physically own the property. You're not, you might be passive, but you are an owner. So you have 100% right to everything that an owner will have. So you can audit the books, you can check the books, and whether you want to or not, that's up to you. But that's sort of, the worst thing that could really happen is that you fire the sponsor. You basically say, hey, you're not doing a good job, you're out. Then a group of investors, you'll more or less come together to figure out who manages it, who wants to step in, and or you can always try to sell the property. If the property is worth more, you'll sell it, you'll make money. If it's worth less, you pay off your debt, you might lose a couple bucks, but at the end of the day, unlikely if the deal going in is the right deal and you have the right debt with the right operator. That answer the question?
Yes. So really, once again, we as lady landlords and business owners, we still have to make sure to do our due diligence. We still have to make sure that we understand what we're investing in and that we're doing our due diligence, not only on the deal, but also the syndicator that we are choosing to work with. Along the lines of this, and I'm trying to group our questions together, so I will get to everybody's, but along the lines with this question, since you just had mentioned too, that we then own a part of the property, do we personally then end up incurring debt while we own this property? Or is that just something that then the managing partner is really responsible for?
Yes, so there are a ton of loans, as everybody knows. There's a bridge loan, private money, agency debt. The easy answer to the question is no. The signer of the debt will be the managing partner of the deal. So you will not incur debt. So if you go out and buy a house, you don't have to report it. It's more often than not non-recourse debt, which means if the deal goes completely upside down with no criminal activity, you basically take your keys, you give it to the bank, you walk away, no harm, no foul. You lose all your money, but no harm, no foul. It does not implicate, it does not affect any passive investors at all. Unless there was a criminal act, then the bank has the right to go after the criminal, which would be the sponsor in that case. But other than that, no. The only way it could potentially affect an individual is if it is recourse, which means that you're gonna, you don't have to sign as a limited partner. The managing partner will sign the loan, but in recourse debt, they could come after the entity. More often than not, that's not the case, because if it is recourse debt, typically the sponsor is going to qualify more off, well more than he has to cover that loan. But the easy answer, 99% of the time, is no, it does not implicate you. And that's another question that you definitely want to ask, what type of debt you're getting, because you want to understand if there is any recourse component, what is it?
Thank you. All right, we're going to move to what I think is our most popular question in the chat. So, is there a minimum to invest in a syndication?
Deal by deal specific, sponsor by sponsor specific. More often than not, there will be a minimum, typically somewhere between $25,000 and $100,000. It just depends on the raise, right? If I was buying $1 million deal and I was raising 200,000, 80% down, or 20% down, 80%. If I was raising 200,000, my minimum is not going to be 100 grand. It might be 10 or 15 or 25. But if I'm raising 15 million or 10 million, my minimum might be a little bit higher. For us specifically, we don't ever have a minimum. We have like a threshold. It might say a $50,000 or $100,000 minimum, but it more or less comes down to total investors. We don't like to put into a deal 50 investors because I don't like reporting to 50 people across 20 deals. So our deals are typically a lot smaller. We always allocate 20% of our deal to new investors. So we're always bringing on new investors. So we're not going to cut anybody out, but our new investor minimum is far less than existing investor minimum. But more often than not, I would assume looking at most deals, you'll see like $50,000 to $100,000, $25,000 to $100,000 minimums.
And within that, I think one of the terms that I at least find very thrown around within this world of syndication is that term accredited investor, non-accredited investor. Can you just define both of those? And then also make sure everybody has an understanding of, if I am accredited or not accredited, does that change my opportunities to get involved in something?
So there are two types, and these are changing daily with real estate's very antiquated business. It's not very technology friendly. Now it's a lot more. Accredited investor used to be a lot harder to achieve, where a lot of these deals were only offered to accredited investors. Our deals are not 100% offered to accredited investors. Our deals are spread out between accredited and unaccredited. Every deal is going to be a little bit different. The general rule of thumb, if the deal is being solicited and marketed on a widespread network, whether it's Facebook, Instagram, just general email blasts, you will most likely have to be an accredited investor. If the deal is being brought to a smaller group of people with an existing relationship, one thing that we like to do to check off that box, if everyone raised their hand right now and said, I want to give you $100,000 each, I would say, unfortunately, I can't. I just met everybody for the first time. We have to get to know each other. And that is just a simple, hey, follow-up call, so on and so forth. So you don't have to be accredited. Every sponsor is going to have their own rules. When we raise more than $5 million, we typically only show those deals to accredited investors. When we raise less than that, we will show it to everybody just because it makes it a little bit easier. But an accredited investor, to check the box off really simply, you either earn $200,000 a year or you have a net worth over $1 million, excluding your primary residence. Now, there's something called a sophisticated investor, and that's someone with extensive experience in the real estate space. So there are a couple of ways to go about it, but for the most part, those two are the easiest ways to see if you're accredited or not. If you check off those boxes, you're good, right? You can invest in any of the deals. If you don't, you have a conversation with the sponsor, see if there's another way to get you in. But it depends on the deal and the sponsor, whether you have to be accredited or not.
And that was something I put the link down once again in the chat box. If anybody wants to have a conversation about what deals are open for you, and if you are accredited or the sophisticated investor, once again, you could go to lady-landlords.com/syndication to get a little bit more clear on really what opportunities are available to you.
Yep.
So,
and a sophisticated investor not only is experience, but it's liquidity, stuff like that. Or if you, it's a mixture of that. So it's not just going to be all or nothing.
thank you. With that, then let's stay on the topic of money here. What is, and once again, this might be a little bit of a loaded question, what is the typical return that an investor can expect through a syndication deal?
Yep. So when we do deals, when we quote returns, we quote net. So when we put a deal out there, you'll see a number that's going to be net of all sponsor sharing, sponsor splits, and fees. Our typical deal is anywhere between 3 and 7 years of a hold, and the typical return is anywhere going to be between 10 and 18. And I only give a wide range. It's really just dependent on market conditions. As you know, in the presentation, I think our average deal has been 28. But you can rest assured you won't ever see a 28 on paper. You most likely will see something realistically probably in the 12 to 18 range is very safe to assume. And that is annual per year. So it's not like 18% over 5 years. Would be 12% each year. Now you might only get 3 or 4 in year 1, 6 or 7 in year 2. Then when the deal sells, you might get 40 or 50% in that year. But you can assume anywhere between 12 to 18 is a very safe number as a passive investor.
Thank you. Then I think the question we also all want to know is, how do I get paid? How do I get my money?
Yep. No, that's a fantastic question. So from our standpoint, what we do, we have no benefit of having all the money sitting in the bank account. So we like to do cash distributions monthly. And we typically start the distributions between 6 and 12 months after we purchase the property. So a typical investor of ours invests January 1st. it takes a good 6 months to really get an understanding, get your plan work. Because when you buy the deal, you rebid all your bids and you start renovating, you start getting tenants out. And then once you really get a good understanding of everything, we look to distribute money monthly. That could either be check, ACH, or wire. Any of those work. We have an investor portal that we use that you can put in your information. It's automatic. You'll get a check, you'll get an email when it goes out. And we look to distribute money as quickly and as frequently as we can, because having a lot of money sitting in the bank doesn't, it doesn't benefit the deal, it doesn't benefit us. We also are moving to, like I said, monthly distributions. We've been doing for the last 2 years on all of the recent acquisitions. Some of the early deals that were very heavy lifts, we're just we're finishing them up. But that should be defined up front. Like, we bought a completely vacant deal. It was 340 units completely vacant. It took us 4 years to get it completely stable. There was no distribution for 4 years, but that was clearly defined up front. So just if when you're looking at a deal, that's a great question to ask, because each deal will differ a little bit. Some deals we buy in the first quarter, we're doing distributions. So, but you can expect quarterly or monthly checks, just depending on the opportunity.
I think that's also really important. And what I think is so great about working like directly with the syndicator is you can look at these different deals and decide what works for you. Not only do you have the opportunity between a land deal, a multifamily, a mobile home park, but then you can say, okay, well, this one, it's going to take me, 10 years to really get like my return. This one might be only 3 years. Maybe this one, then I'm going to get a higher return because it's going to move, because I'm going to put my money in there a little bit longer. Or, hey, I want something, I'm willing to take a little bit of a less return to do something that's going to have a little bit of a turnover faster. I'm willing to do something that is going to be a value add. I'm going to do something that's a refinance play. So it really is interesting to look at the opportunities and make sure that the syndication deal that you are moving forward with, that you have that conversation with that syndicator, really matches what you need in kind of your strategy right now to add to your portfolio. So I hope that helps some of you out there considering this. So one thing that also, sticking with this money side, a lot of us really like to invest in real estate for tax benefits. Are there any tax benefits to investing in a syndication?
Yes. Caveat that with the only one that does not have tax benefits is land, because there's just not much. It is what it is. When you buy a building, the only thing you can't depreciate is land. So all of our other deals, without a doubt, have massive tax benefits. We do cost segregations on nearly all of them. So you'll get all the benefits of the tax benefits in every deal other than a land deal. The land deal, in my opinion, should generate a high enough return that you don't mind paying taxes, because the return should be a little bit higher. But yes, as a regular limited partner in our deals, the tax benefits are 100% passed through to the investors. So you get all the depreciation and all the good write-offs and all of that. A lot of our deals in the first 3 or 4 years will have shown losses on the document you get as a passive investor is a K1 at the end of the year. You'll get a K1. You will 9 out of 10 times have a negative number on your K1 with a positive distribution. So you might get $5,000 in distributions and you'll show negative, $14,000 on your K1. So you submit that, you don't pay any taxes on the $5,000. And now we all know when you sell the building, you have to recapture all of the depreciation, but we figure that stuff out in the future. So you do get the tax benefits as a passive investor.
Fantastic. I know that makes a lot of us on this call very, very happy. We do not want to lose those. One specific question from Kathy that was asking about with the land deal specifically, how does zoning with the subdivisions, like how does that really like work out? Like with this land play, what kind of effect could then a zoning board really kind of have on any issues and any plans that we might have with the land deal?
Absolutely. Excellent question. So we avoid those because what we are doing are basically survey and subdivision exempt, or basically exempt subdivisions. So each state, each county is going to have their own rules. We are not looking to do urban infill subdivisions. So for instance, I'll use Texas because almost all of our properties are in Texas at this point. In Texas, you can subdivide anything down to 10 acres or more, and you don't need a platted survey and you don't need approval from the county to do it. You need approval, but the approval is you get a survey done, a regular survey. They draw in the subdivisions, you submit it, stamped, approved, done. There's no argument against it. With that comes, you need road frontage on a county road. So if you buy a 10-acre or 100-acre property with no road access, you're going to have to put in roads. So to avoid any approvals or planning or county ordinances, we look for the larger tracts that we could subdivide into 10 acres or greater in Texas. And you typically are exempt from any of that approval stuff that you would normally see on a lot of other things. South Carolina, it's 5 acres or greater. So understanding the rules helps us to do that. Now, like that Montgomery County deal that that was in that list, that was a 10-acre site we bought, and we subdivided it down into 2-acre lots. It was like a 2-acre, 2-acre, 3-acre, and a 1.9 acre. We had to get a platted survey, which just cost a little bit more and it's more time, but that platted survey would get that approved. It'll be submitted. It's just going to take like 3 to 4 months, when an exemption can take, as little as, 2 to 3 months.
Gotcha. Thank you. Kathy, I hope that helped. I see you give me the thumbs up. So good, Kathy. You had some really good questions in the chat. So I'm glad we got that one in. John, one of the next questions, one of the last questions I really have for you tonight before we wrap up here is, you talked about some of these with this specific land deal, right? Some things are already under contract. I'm sure that same thing happens with those multifamily syndications. At what point does this opportunity close to get involved in the syndication? Is that as soon as you sign a contract? What is that point to really get involved? When does that chance end for those of us?
Yes. So in this particular deal, as I mentioned before, we are very well capitalized. So we have bought 3 of those 5 properties, and there will be a 6th one or potentially a 7th one included in there. We are cutting off funding for this deal. I don't want to give a hard date because we really don't know. It won't be past April, probably. We have a lot of interest, but at the same time, we have the capital to buy everything. When we sell a deal, the benefit of this fund is that it's going to be, as in this particular situation, you will be invested in the deal the day you invest. So your return is based on the days invested. So it's like a weighted average. So if we're raising 100 grand and you put in 10,000 day one, your weighted average is you're going to get 100% of the benefit. If you come in, let's say halfway through, it's just a weighted calculation. So we're not closing this yet. We have 2 more deals. And there's going to be a total of 6 or 7 deals. There's 2 more deals that are closing. They're closing at the end of this month. And we're going to just probably extend the raise maybe to the end of April. We don't know. If we get just a ton of interest, we might close it out a little bit earlier than that. But yeah, no, there's time. Additionally, this was the first really truly raise for land deals that we did. We've done one-offs here and there. It's like, okay, we're going to buy this deal, raise money, sell it. This was, we put a bunch of them together. One thing we are considering, because our pipeline is pretty extensive, is closing this out a little bit earlier than we think, and then doing a phase 2. So where we will, if we close this out, if anyone were to be interested and we just can't connect or whatever it is, if we close it out, we're going to do a phase 2 because our pipeline is really extensive and we have some really good deals. And we do think it's, a good opportunity for a lot of people. So there is no hard date, and we will have another one. And then simultaneous with that, anyone that expressed interest in this immediate thing is going to have a first right of refusal, whether they invest or not, in a potential future RV, mobile home, and or multifamily deal. So we're giving people that are at least interested, they're going to get a first shot, because we've had a lot of interest in deals, and we just have, COVID was a tough year, and last year we just did not really buy much multifamily and stuff like that. So these particular deals are all open and available. My suggestion is, I'm not the pressure type, but it would be on a first come, first serve basis. But we're flexible. We have a lot of capital in these deals. We're raising $4 million total for all the deals. I will have $1 million, no less than in the deal. So I won't drop below that. But if I have $1.5 million and someone wants to come in, I will just take out my money first before it impacts any investors.
Thank you. All right, we got time for one more question here, and I'm going to read out Kathy's question from the chat box for you, John. Before we wrap up, I want to be able to respect everyone's time tonight. But Last question. Kathy says, why is it better for you as the managing partner to spend all the time to bring in extra investors in instead of just doing fewer properties and keeping the easy money part for yourself instead of distributing it out to all the rest of us? Good
Fantastic.
question, Kathy.
No, that is a fantastic question. I battle that every day. You guys obviously don't know me. I pretend to myself that I want to do fewer deals with less people by myself, and I don't like the headache. And then I find myself on a webinar at 8:30 Eastern time, trying to get more investors. I think real estate is a very simple game. It is who you know in a networking business. I've had a lot of help getting to the position that I'm at today. It's not fair, nor there's nobody that doesn't have enough time to at least extend the opportunity to at least help somebody get into something that they maybe did not think they were available. So for me, yes, could I do half the deals and maybe do it a little bit less? Absolutely. But it's no skin off my back. I love real estate. And when I set out to do this, my intention was to build a community for people, not only to invest in our deals and my deals, but to get to know other people in our deals and build a community for people that like to do real estate. So yes, could I do it? Absolutely. Can maybe in the future I get there? Maybe, but right now I do want to extend our opportunities to as many people as possible, keeping in mind that we are selective. So we want to make sure it's the right deal for our partners. That's where that delicate balance comes into. If I don't think it's the right deal, it doesn't mean we won't take or help you invest or something like that. It just might be, hey, we're not going to take 100, we're going to take 25 because I don't think this is right. So the easy answer is I like to give back, and I want people to be able to take advantage of our deals like I've had a ton of help getting to where I am today.
And that also, to me, one of the reasons that I also really connected with John is because we're both people that like to grow a community. We like to do things as a group and really make sure that as we're kind of growing as investors, that we're helping others kind of get to that point too. So that was just something that I thought was really a unique relationship that John and I have been able to kind of build over the past couple of years. But once again, I want to make sure that we kind of wrap up here now. We've got through all those questions. If you feel that there were questions that you still had, once again, you can either shoot me an email or once again, head to lady-landlords.com/syndication. And I'm happy to hop on a call and kind of talk through this with anybody if they want to see learn a little bit more and see if this is something right for them. Otherwise, let's all thank John down in the chat box for his time. I like the applause, everybody. Thank you all very much for joining us tonight. I will be making sure to be sending out this recording as soon as it's ready, probably in the morning. I will send that out. So if you missed any part of it, you can go back and be able to watch it. And as always, thank you so much for joining us tonight. I hope you were able to learn more about syndications, and I will see you all back in the Lady Landlords Facebook group shortly. Good night.